Most traders are obsessed with finding the perfect entry. They believe if they can just get in at the exact right moment, everything else will take care of itself. But here's the uncomfortable truth. Timing your entry means nothing if you don't understand why the market is moving when you act. Think about that for a moment. How many times have you entered a trade that looked perfect, only to watch it stall, reverse, or slowly bleed against you? The issue isn't that you were early or late. The issue is that you didn't read the condition behind the price. Let's start with a simple observation. Markets don't move randomly, not in the way most people think. They move in phases. Quiet accumulation, sudden expansion, exhaustion, then either continuation or collapse. You've seen this, haven't you? A slow grind, then a sharp breakout, or a strong rally that suddenly loses energy and drifts sideways. But here's the question. Do you enter based on what price looks like, or based on what phase the market is actually in? Because those are two very different decisions. Most traders enter during excitement. They wait until the move is obvious, until momentum is undeniable, until everything confirms. And by then, they're stepping into a move that's already halfway finished. Why does that matter? Because timing isn't about being right. It's about being positioned before others realize what's happening. If you enter late, your risk increases and your margin for error shrinks. If you enter too early, you sit through noise and doubt. So where does that leave you? Somewhere in between, but not randomly, deliberately. Here's the explanation most people miss. Entry timing is not about predicting the future. It's about aligning with pressure. Ask yourself this. Who is being forced to act right now? Is it buyers chasing price higher? Is it sellers trapped in losing positions? Is liquidity being taken, or is it being built? Because price doesn't move just because it wants to. It moves because someone is being pushed out. And if you can recognize that pressure early, your entries stop being guesses and start becoming responses. Now consider the implication. If you wait for confirmation, you're reacting to what has already happened. If you anticipate without evidence, you're gambling. So what's the balance? You look for shifts, not signals. A shift in momentum, a shift in behavior, a shift in how price reacts to levels that previously held. Have you ever noticed how sometimes price touches a level and bounces aggressively, and other times it barely reacts at all? That difference is timing. Let's make this practical. Instead of asking, is this a good entry? Start asking, what has just changed? Has volatility expanded after a period of compression? Has price stopped respecting a trend line it followed for hours? Are candles closing differently? Stronger, weaker, more uncertain? These are not indicators. These are clues. And the more you train yourself to see them, the more your entries become less about courage and more about clarity. But timing doesn't end at entry. In fact, entry is only half the equation. Exit timing is where most traders quietly lose everything they gained. Let me ask you something. How often do you exit based on fear instead of structure? You see a little pullback and you close early. Or worse, you hold on because you feel it should go further. Neither of those decisions has anything to do with the market. They have everything to do with you. Here's the reality. Exits require just as much observation as entries, but with a different mindset. When you enter, you're looking for opportunity. When you exit, you're looking for change. Has the reason you entered the trade disappeared? If you entered on momentum, is that momentum still present? If you entered on a breakout, is price still accepting above that level? Or are you holding onto a story that no longer exists? This is where discipline reveals itself, not in entering trades, but in leaving them, because exiting well often feels uncomfortable. It feels like you're leaving money on the table. It feels like you might be wrong. But let me ask you, would you rather exit early with clarity or stay longer with uncertainty? One builds consistency, the other builds regret. There's another layer to this that most traders avoid thinking about. Timing is deeply psychological. You don't enter late because you lack knowledge. You enter late because you need reassurance. You don't exit early because the setup failed. You exit early because you fear losing what you've gained. So the real question becomes, Are you timing the market or are you timing your emotions? Think about a trade where everything worked perfectly. Clean entry, strong move, controlled exit. What made it different? It wasn't luck. It was alignment. Your decision matched the market's behavior. No hesitation, no forcing. Now compare that to your worst trades. Were they really bad setups, or were they poorly timed decisions driven by impatience or fear? Here's where application becomes powerful. Before every trade, pause and ask, what phase is the market in right now? Who is in control? Buyers or sellers? Am I entering because I see a shift, or because I don't want to miss out? And after you enter, ask, what needs to stay true for this trade to remain valid? If that condition disappears, will I recognize it quickly, or will I hesitate? This is how timing evolves, from instinct to awareness. You stop chasing entries and start waiting for alignment. You stop guessing exits and start responding to change. And over time, something subtle happens. You take fewer trades but better ones. You feel less urgency but more control. And most importantly, you begin to trust your decisions. Not because they always win, but because they are grounded in something real. But here's the part most traders never fully confront. If timing is about alignment, and alignment requires patience, then why do so many traders feel the need to always be in the market? Is it opportunity, or is it discomfort with waiting? Because if you can't wait for the right moment, you'll always convince yourself that this moment is good enough. The best trades begin before they look obvious to the crowd. That idea sounds uncomfortable at first, doesn't it? Because everything you've been taught tells you to wait for confirmation, to wait until the move is clear, to wait until the market proves itself. But by the time something becomes obvious, the opportunity has already begun to fade. Think about how a typical move unfolds. Price doesn't explode out of nowhere. It builds, quietly, almost unnoticed. There's a phase where the market feels slow, even boring. Small movements, tight ranges, nothing exciting. And during that time, most traders lose interest. They step away or start forcing trades elsewhere. But what's really happening in that quiet phase? Positions are being built. Pressure is forming. Strong hands are preparing before the move becomes visible. And while the majority is waiting for something obvious, a smaller group is already positioning themselves. So ask yourself, are you waiting for clarity or are you waiting for comfort? Because those two are not the same. Clarity comes from observing subtle changes. Comfort comes from seeing a move already in progress. And comfort is expensive. It costs you your entry, your risk, and often your confidence. When a breakout becomes obvious, what do most traders do? They chase it. They see strong candles, increased volume, momentum building, and they jump in. It feels safe because everyone else sees it too. But that's exactly the problem. When everyone sees it, most of the move has already been priced in. And what happens next? Either the move slows down, pulls back, or temporarily reverses. Not because the idea was wrong, but because the timing was late. Now consider a different approach. Instead of focusing on the breakout itself, focus on what happens before it. Watch how price behaves near key levels. Does it keep returning to the same area without breaking lower? Are the pullbacks becoming weaker? Is volatility compressing? These are not dramatic signals. They don't feel exciting. In fact, they often feel uncertain, and that's why most people ignore them. But that uncertainty is where opportunity lies. Because when you learn to read those early signs, you stop relying on confirmation and start recognizing preparation. You begin to see when the market is coiling rather than when it has already sprung. Let me ask you something. Have you ever watched a setup form, hesitated, waited for confirmation, and then entered only to feel like you were chasing? That feeling isn't random. It's the result of entering after the shift has already happened. The market doesn't reward the most obvious decision. It rewards the most well-timed one. This doesn't mean you should blindly anticipate every move. That would just be guessing. The difference is subtle but critical. You're not predicting. You're observing behavior that suggests something is about to change. For example, when price stops reacting to negative news, or when it refuses to drop despite selling pressure, something is different. That difference is often the earliest sign of a coming move. But here's where most traders struggle. Acting before the crowd feels uncomfortable. It feels like you might be wrong. There's less validation, less agreement, and that discomfort pushes you to wait. So again, what are you really waiting for? If you wait for everyone else to see it, you're no longer early. You're part of the reaction, and reaction is always slower than preparation. The traders who consistently find strong entries are not faster thinkers or luckier participants. They are simply more comfortable acting when the evidence is subtle, not obvious. They trust shifts in behavior more than loud signals. They understand that the market reveals its intentions quietly before it expresses them loudly. And once you begin to see that, you realize something important. What feels uncertain to the crowd is often structured to the trained eye. A shift in behavior matters more than a signal on your chart. That might sound strange when you've spent so much time learning indicators, patterns, and confirmations. But let's be honest, how often have you seen a perfect signal fail? The problem isn't the signal itself. The problem is what you expect it to represent. Most traders treat signals as decisions, a moving average crossover, an RSI level, a breakout candle. They see it, and they act. But a signal is only a reflection of what has already happened. It tells you where price has been, not necessarily where it's going. So the real question is, what is the market doing differently right now? Because behavior is alive. It changes in real time. And when you learn to observe that change, you begin to see the market in a completely different way. Think about a strong trend. Price respects a structure, pulls back cleanly, and continues. It behaves consistently. Now imagine that same trend, but suddenly the pullbacks become deeper. The moves upward lose strength. Levels that once held easily begin to weaken. No indicator needs to tell you something has changed. You can see it. But do you trust what you see, or do you wait for a signal to confirm it? That hesitation is where most traders lose their edge. Because by the time a signal reflects that shift, the market has already moved. The early advantage is gone. You're no longer responding to change. You're reacting to confirmation. Let me ask you something. Have you ever stayed in a trade even when it felt different? Just because your indicator hadn't given an exit signal yet. That feeling wasn't random. It was your awareness picking up on a shift in behavior. Maybe momentum slowed. Maybe price started hesitating at levels it previously broke through. Maybe volatility changed. Those are not small details. They are the market communicating. And when you ignore them in favor of a fixed signal, you're choosing delay over awareness. Signals are static. Behavior is dynamic. That distinction matters more than most people realize. When you rely too heavily on signals, you start outsourcing your judgment. You stop asking questions. You stop observing. You wait to be told what to do. But trading doesn't reward passivity. It rewards attention. So instead of asking, did my setup trigger? Start asking, is price behaving the way it should? If you're in a breakout trade, is price holding above the level, or is it slipping back? If you're in a trend, are the pullbacks controlled, or are they aggressive? Because a valid trade has a certain character, and when that character changes, something important is happening. Now here's the subtle part. Behavioral shifts are rarely dramatic at first. They don't announce themselves. They show up quietly. Slight hesitation, weaker follow-through, inconsistent reactions. And because they're subtle, they're easy to ignore. But that's exactly why they matter. They give you an earlier read than any signal ever could. Let's take a simple example. Price approaches a resistance level multiple times. Each rejection becomes weaker. Sellers are still there, but they're losing strength. The level hasn't broken yet, so technically nothing has changed. But behavior has. So what matters more? The fact that resistance is still intact, or the fact that it's weakening? Most traders wait for the breakout. Fewer notice the weakening before it happens. And that difference is timing. Now flip the situation. Price breaks out strongly, triggers every breakout signal, pulls in traders, and then stalls. It stops advancing. It starts drifting, maybe even dips back below the level. The signal said, go. But behavior is saying something else. Which one do you listen to? This is where real decision-making begins. Because trading isn't about following instructions. It's about interpreting information, and behavior carries more information than any indicator can compress into a signal. But interpreting behavior requires presence. You can't rush it. You can't automate it fully. You have to watch, compare, and question. What is different now compared to before? That one question can change how you see the entire market. Late entries are usually emotional confirmations, not strategic decisions. That may be hard to accept at first, especially if you believe you're being patient by waiting. But patience and hesitation are not the same thing. Ask yourself this. When you enter late, what are you really waiting for? Is it clarity or is it reassurance? Because most of the time, it's not about needing more information. It's about needing to feel more certain. You want the market to prove you right before you commit. You want to see momentum, strong candles, other traders jumping in. You want evidence that reduces doubt. And in doing so, you quietly trade away your edge. Think about the moment just before you enter a late trade. Price has already moved. The setup looks clean. Everything aligns. It feels safe. But why does it feel safe? Because the uncertainty is gone. The move is visible. The direction is agreed upon. You're no longer thinking independently. You're aligning with the crowd. And here's the uncomfortable truth. By the time something feels safe in the market, the risk has already shifted against you. Let me ask you something. How often have you entered a trade that looked perfect, only to see it stall almost immediately? That's not bad luck, that's timing. When you enter late, your stop has to be wider or your position becomes fragile. Your entry is closer to exhaustion than to opportunity. You're stepping into a move that has already consumed much of its energy. But emotionally, it doesn't feel that way. Emotionally, it feels like confirmation. And that's where the trap lies. Because confirmation gives you comfort, but it also delays your action. And in trading, delay changes everything. Now consider the opposite scenario. You see a setup forming. It's not perfect yet. There are still questions. Maybe the breakout hasn't happened, or the trend hasn't fully established. You recognize potential, but there's still uncertainty. How do you feel in that moment? Probably hesitant, maybe even doubtful, and that discomfort often keeps you out. So what do? You wait. You tell yourself you're being disciplined. You tell yourself you need confirmation. But what you're really doing is avoiding discomfort. And by the time that discomfort disappears, the opportunity has already shifted. This is why late entries are rarely strategic. Strategy is built on observation, preparation, and timing. Emotion is built on relief, fear, and validation. So when you enter late, ask yourself honestly, did I plan this, or did I react to how I feel right now? Because reaction is always tied to emotion. Now here's where it becomes more subtle. Not every late entry feels emotional. Some feel logical. You justify them with reasons. You point to the breakout, the indicator, the structure. But underneath those reasons, there's often a simple driver. You didn't want to be wrong earlier, so you waited. And once the market moved in the expected direction, you allowed yourself to participate. But at that point, the trade is no longer the same trade. The risk has changed. The context has changed. The reward potential has shrunk. You're no longer early. You're late with justification, and justification is not the same as strategy. Let's break this down practically. When you plan a trade, you define your entry based on conditions, not feelings. You know where the opportunity lies before the move becomes obvious. But if you only act once the move is already in progress, your decision is no longer based on that plan. It's based on what you're seeing after the fact. That shift, from planning to reacting, is what turns timing into a problem. So the real question becomes, how do you recognize when you're about to enter late? Pay attention to your internal state. Are you feeling relief that the market is finally moving? Are you afraid of missing out? Are you rushing to get in before it goes too far? These are not signals. These are emotional cues. And they often appear right before a late entry. Now this doesn't mean you should always enter early. Blind anticipation is just as dangerous. The goal is not to eliminate confirmation. It's to understand your relationship with it. Are you using confirmation as a tool or as a crutch? Because when confirmation becomes a crutch, you stop trusting your preparation. You wait for the market to remove uncertainty completely. And the market never does that for free. There will always be uncertainty. The difference is whether you act with it or wait until it disappears. Timing improves when you focus on what just changed, not what already happened. That sounds simple, but most traders do the exact opposite without realizing it. They study what has already unfolded. They analyze past candles, completed patterns, confirmed breakouts. They build their decisions on things that are finished, things that cannot change, and while that feels logical, it places them one step behind the market at all times. Let me ask you something. When you look at a chart, are you reading a story that's already been written, or are you paying attention to how the story is currently shifting? Because those are two very different perspectives. The past gives you context, yes. It shows you structure, behavior, tendencies. But the past doesn't create opportunity. Change does. And change happens in the present, often in ways that are easy to miss if you're too focused on what has already been confirmed. Think about a strong level in the market. Price has respected it multiple times. It's clean, obvious, well-defined. So naturally, you expect the same reaction again. But then something subtle happens. Price returns to that level, and the reaction is weaker. Maybe the bounce is smaller. Maybe it takes longer. Maybe buyers hesitate instead of stepping in aggressively. Nothing dramatic. No breakout yet. No clear signal. But something has changed. Do you notice it? Or do you ignore it because the level hasn't officially broken? This is where timing begins to separate itself. Most traders wait for the break. They want to see the level fail before they act. That feels safe. It feels confirmed. But by the time the break is obvious, the shift has already played out. The real information was in the weakening reaction, not the final move. So again, what matters more, the event or the change leading up to it? Because the event is what everyone sees. The change is what few pay attention to. Now consider another situation. A market is trending upward, clean structure. Higher highs, higher lows. Everything looks strong, so you expect continuation. But then, gradually, the behavior starts to shift. The pushes upward lose momentum. The pullbacks become deeper. Price starts overlapping instead of moving cleanly. No signal has told you the trend is over. Technically, it might still be intact. But does it feel the same? That question matters. Because when you focus on what just changed, you stop relying on labels like uptrend or downtrend. You start observing the quality of movement instead. Is it strong or weak? Decisive or hesitant? Controlled or chaotic? These qualities change before the structure officially breaks. And if you can recognize those changes early, your timing improves naturally. You don't need to predict the exact top or bottom. You just need to see when the behavior is no longer supporting the current idea. Let me ask you this. How often do traders hold onto a bias simply because the structure hasn't fully broken yet? They stay bullish because the trend line is still intact. They stay bearish because resistance hasn't been breached. They wait for confirmation. But in doing so, they ignore the fact that the market has already started behaving differently, and behavior always shifts before structure. That's the key. Structure is the result. Behavior is the cause. If you focus only on results, you'll always be late. If you focus on causes, you give yourself a chance to act earlier with better positioning. Now here's where it becomes practical. Instead of asking, what is the market doing? Start asking, what is the market doing differently than before? Is price reacting faster or slower? Are moves extending or failing? Are levels holding with strength or barely holding at all? These questions keep your attention on change, not history. And over time, this changes how you make decisions. You stop waiting for perfect setups that are already obvious. You start recognizing moments where something is shifting, even if it's not fully visible yet. That doesn't mean every change leads to a trade. Some shifts fail, some reverse. But the point is not to act on every change. The point is to see them clearly. Because once you can see change as it happens, you're no longer anchored to what the market has already done. You're aligned with what it's beginning to do. Strong exits come from invalidation, not hesitation. That distinction is subtle, but it changes everything about how you manage a trade. Most traders don't exit because something changed. They exit because something felt uncomfortable. A small pullback, a moment of hesitation in price, a flicker of doubt, and suddenly the urge to close the trade appears. Let me ask you, when you exit early, what are you really responding to? Is it the market telling you your idea is no longer valid? Or is it your mind trying to protect you from uncertainty? Because those are not the same thing. Hesitation is emotional. Invalidation is structural. Hesitation comes from fear, fear of losing profits, fear of being wrong, fear of watching a winning trade turn against you. It's reactive. It's immediate. It doesn't ask questions. Invalidation, on the other hand, is based on a clear condition. Something that made your trade valid is no longer true. And if you don't define that condition before entering, you'll never know the difference when it matters. Think about your last trade. Why did you exit? Did the market actually break the logic behind your position? Or did you just feel like it might? This is where most traders lose consistency, not in entries, but in exits that are driven by uncertainty instead of clarity. Now consider how a well-timed exit actually works. Before entering a trade, you have a reason. Maybe it's a breakout, a trend continuation, a rejection from a level. That reason creates an expectation. Price should behave in a certain way if your idea is correct. So the question becomes, what would need to happen for that expectation to fail? That's your invalidation point. Not where you hope to exit. Not where it feels comfortable, but where the market proves your idea wrong. Let me ask you this. Do you define that point clearly before you enter, or do you figure it out while you're already in the trade? Because if you're deciding in real time, your emotions are already involved. And once emotion takes over, hesitation follows. You start second-guessing. You start reacting to every small movement. A minor pullback feels like a threat. A pause feels like weakness. And before the trade has a chance to develop, you're already looking for a way out. That's not timing. That's avoidance. Now flip the perspective. Imagine you enter a trade with a clear understanding of what must stay true. You know what behavior confirms your idea, and you know what behavior invalidates it. So when price moves, you're not reacting blindly. You're comparing. Is the market still behaving as expected? Or has something changed? That comparison creates stability. Because now, your exit is not based on how you feel in the moment. It's based on whether the original reason for the trade still exists. And that's a completely different mindset. Let's make it practical. If you enter on a breakout, what needs to happen for that breakout to remain valid? Price should hold above the level. It should show acceptance. Momentum should follow through. If instead price breaks out and then quickly falls back below, stalls, or shows rejection, something has changed. That's invalidation. Not a small pullback, not a moment of noise, but a clear contradiction of your original idea. And when that happens, exiting is not emotional, it's logical. But here's where traders struggle. They often recognize invalidation and still hesitate. Why? Because they don't want to accept being wrong, so they wait. They hope. They give the trade more room. And in doing so, they turn a controlled exit into a larger loss. Let me ask you, how many times have you stayed in a trade even after you knew something was off? That moment of knowing, that's awareness. But if you don't act on it, hesitation takes over. And hesitation doesn't protect you. It delays the inevitable. Strong exits require decisiveness, not certainty. You don't need to be 100% sure the trade has failed. You only need to recognize that the conditions supporting it are no longer present. That's enough. Because trading is not about being right all the time. It's about managing when you're wrong. And exits are where that management becomes real. If you wait for certainty, you'll always exit too late. If you react to fear, you'll exit too early. So where does that leave you? If the reason for your trade disappears, your position should too. It sounds obvious when you hear it stated plainly, but in real time, most traders don't follow it. Why? Because once you're in a trade, your focus quietly shifts. You're no longer thinking about why you entered. You're thinking about what you might gain or lose. Let me ask you something. When you're in a trade, are you still evaluating the idea, or are you managing your emotions around the outcome? Because those are two very different processes. Every trade begins with a reason, a setup, a condition. Something you observed that made you believe price would behave in a certain way. That reason is the foundation of your decision. But what happens after you enter? Price moves, sometimes in your favor, sometimes against you. And as it moves, your attention often drifts away from the original reason and toward the fluctuating profit and loss. That's where the disconnect begins.